Hello everyone and welcome everyone to another class for CFA Level. In today's video, we will be doing the liquidity related concept in working capital and liquidity. So you would have seen in the previous class, we had done working capital related concepts. Okay. In the working capital related concept, we had seen what is working capital. Okay. We had seen cash conversion cycle. We had seen ratios. Then we took up a topic which discussed whether cash conversion cycle higher is good or lower is good, and the management aspects associated with it. And then we discussed about working capital policy. Okay. In today's class, we will start with a fresh topic, that is liquidity. So, what is liquidity? We will be covering what is liquidity, some ratios associated to liquidity, the management aspects, and some associated topics. Okay. So the flow of the content will be similar as that of the previous class. We will start with liquidity and do the other associated concepts. Okay. So let us see what is liquidity. Guys, what do you think? What is liquidity? Guys, please suggest what do you understand by liquidity? Basically, liquidity is used. It is used in relation to an asset. To an asset, and indicates the ability to convert the asset into cash without quickly, without much loss in value. Okay. So basically, when do we call an asset to be liquid? When we can say that yes, this asset can be converted into cash or bank in a substantially fast period of time without losing its value. Okay. So we will take some examples. Guys, we will take some examples so that we understand it better. Is inventory liquid? Guys, is inventory liquid? Yes or no? Guys, is inventory liquid? Yes or no? Yes, inventory is liquid. Short term investment? Is short term investment liquid? Whether you can convert it into cash quickly without losing much of its value? Guys, is it liquid? Guys, yes or no? Please suggest. Guys, please suggest. What do you think about short term investment? Yes, it is liquid. Is building liquid? Can you convert building quickly without much loss in value? Guys, tell me. Whether do you consider a building to be liquid or no? Building is not liquid. Is land liquid? Can you convert land into cash substantially fast without losing much of its value, guys? Yes or no? Okay. So with this example today, we have understood that liquid assets are those which can be quickly converted into cash without loss of value, without much loss of value, right? So what are the keywords that we have seen over here? Convert into cash quickly plus without much loss of value. Okay, these three are important terms in terms of liquidity. Okay, now with liquidity, we will have some associated concept we will learn from here only. Okay, what is the definition of liquidity given? Liquidity refers to how easily and quickly an asset can be converted into cash without a significant loss of value. Yes, this is what we had studied. It is essentially the ability to access funds when needed. So basically what it is saying that since I have the ability to convert my assets into cash, whenever I need funds, I will be able to generate funds because I have liquid assets. In other words, it is the nearness to cash. So this is an important term, nearness to cash. So sometimes what will happen, rather than using the word liquidity, the question might also give you nearness to cash. So you need to understand that whenever this term nearness to cash is given, it is nothing but it is referring to liquidity. Okay, guys. Then we come to sources of liquidity. Then we come to sources of liquidity. Sources of liquidity basically means from where do you get cash? Sources of liquidity means from where do you get cash? Just think of a business operation. Okay. Just think of a business operation that when I'm running a business, what are the areas from where I can get a cash? One, when I make a goods or service sale in cash, yes or no? When I make a sale in cash, I will get cash. Second, when I'm making a credit sale, but I am recovering the money from the debtor, guys, yes or no? Guys, yes or no? First, I am making a sale in cash. Second, I have sold the product in credit or I have sold the services in credit, but I am recovering the money from the debtor. The third way, when I'm borrowing something, yes, see, we are not here considered or talking about. See, over here, we are neither considered nor we are talking about whether it is an income or not. We are only talking about whether the cash has come into the business or not. So, when you ask money from someone, when you borrow from someone, that also brings money in the business. Yes or no? And the fourth point, which is given in the book but a bit theoretical, is effective cash management. So, basically, what this point is saying is that if you effectively manage your inflows and outflows properly, that is also a primary source of liquidity for your business. Why? Because if your management is effective, you will always have necessary funds in order to fund your operations. So these are the primary sources of liquidity: sale of goods and services, collection of receivables, effective cash flow management, and bank borrowing. Then we talk about the secondary sources which are sub to the primary sources. Cash saved by suspending dividend to shareholders, delaying or reducing capital investment. So basically, what is this? Avoiding outflow, selling of assets. Do you really think selling of assets is a logical method to bring cash in the business when the asset is useful to the business? No. That is why it is kept in the secondary space. Issuing additional equity and restructuring debt to extend its maturity. In all these cases, majority is talking about avoiding cash flows. Okay, sources of liquidity. Then we come to drag and pulls on liquidity. Okay, now what is a drag? See, when you look at the literal meaning of drag, what do you mean as drag? Guys, if you uh, search the literal meaning or the English meaning of drag, correct? That meaning is applied on liquidity. What is drag? Drag means delay or reduced cash inflows, right? Creating difficulties. When I'm doing pull, it means accelerating inflow. Pull means pull, right? When you're pulling something. So when you're pulling your inflows, it is a pull on inflow. When you're pulling your liquidity, drag means when you are getting it in a delayed manner, creating problems. Then we come to important liquidity ratio. There are three liquidity ratios that you will have to discuss. One is the current, other is the quick, and the other is the cash ratio. What does liquidity ratios indicate? Liquidity ratios are determine the ability of the firm to pay short term liabilities. Okay. So what is liquidity ratio? Determines ability of firm to pay off its short term liability. Is it something similar to what we have seen in the last class? Yes. Working capital also in absolute terms indicate that only. Correct. That is why liquidity ratio are also referred to as working capital ratios. So guys, always remember liquidity ratios are also referred to as working capital ratios. So guys, always remember liquidity ratios are also known as the working capital ratios. So there are three working capital ratios or liquidity ratios. Current ratio, second, second acid test ratio or liquidity ratio, and the third is cash ratio. In the current ratio, it is given as current assets minus current liability. What was your working capital? Working capital was current assets minus current liability. So basically, it indicates that in order to pay 1 rupee of your short term liability, how many current assets you have in the business. We will see it again. This shows that in order to pay rupee 1 of short term liability, how much current assets you have. Guys, are we clear? In the acid test ratio, what do? We will remove inventory out of it. Guys, we will remove inventory out of it in the acid test station. Now you guys need to think and tell me in the comment, why do you think in the acid test ratio the inventory is removed? Guys, you need to tell me that in the liquidity ratio. Guys, you need to tell me that in the uh, acid test ratio, also known as the quick ratio. Okay, you need to tell me why do you think inventory is removed? What is the thought process behind it? Guys, can you tell? See, let me tell you the thought process behind it. Quick ratio, by its nature, is asking for 1 rupee of current liability. How much assets can be quickly used to settle the liability. Okay. Now you need to understand, although inventory is a current asset, okay, by definition. Why? Because inventories are kept in the business not for more than 12 months. So inventory is a current asset. It was a part of the current ratio. But why do you think, in case of a quick ratio, my question is, in order to pay 1 rupees of current liabilities, what are the assets which can be quickly converted into cash? Now, do you think when you have an inventory and when you have a liability of rupees 1, you will be immediately able to convert inventory into cash? Do you think? Suppose you have a raw material. Do you think if you want to make a payment tomorrow or make a payment after 1 week, you will be able to convert that raw material into finished good, then sell it and get the cash back? Is it possible? Is it business? Is it logically feasible? No. Which means, although inventory is a current asset, and can be converted into cash in a relatively faster manner, but when we talk about quickly, inventories cannot be converted quickly into cash. That is why when we talk about the quick ratio, we remove inventory out of this equation, because inventories cannot be quickly converted into cash. Okay. The last ratio that we will talk about is the cash ratio. Like the name says, it simply says that in order to settle 1 rupees of current liability, how much cash or cash equivalent you have. Okay. So how it is said? Current assets minus inventory minus accounts receivable. Is accounts receivable cash or cash equivalent? No. Accounts receivable is not a cash or cash equivalent. Why? Because accounts receivable will also take its own due time based on the credit period in order to convert into cash. So accounts receivable are also not cash and cash receivable divided by current line. So basically, in liquidity ratios, in each ratio we have deep dived the level more. Initially, the current ratio, it was 1 rupees of current liability, and how much amount is there in terms of short-term assets. When we went to quick ratio, for 1 rupees of current liability, how much of the short-term assets can be quickly converted into cash. In the third ratio, which is the cash ratio, for 1 rupees of current liability, how much of the current assets is there which is a cash or cash equivalent. So in every step, we have been going to more and more liquid assets. Okay, guys, please note, this is an important area from a question point of view. There is a possibility of question on this topic. The last topic that we have to study is the factors that affect a firm's approach to short-term funding. Okay, so basically, what are the aspects based on which a company can make its short-term funding policy? Aspects based on which the policy aspects of policy making. Guys, did we study about the working capital policy in the last class? Guys, did we study about the working capital policy in the last class? Yes, we had studied. What did we study in the last class? Guys, what did we study in the last class about working capital policy? Guys, what did we study in the last class about working capital policy? Did we study that working capital policy can be aggressive? It can be balanced and it can be conservative. Yes or no? Did we also study that it is a management decision? Correct. Now what we will study is that what are the factors influencing it. Okay, let us study. The first factor that we will study is company size. Yes, if your company is a large size company, you will have more number of options and avenues to raise fund. If your company is a small size company, then the avenues that you will have to raise funds are limited. Yes or no? Smaller firms have limited options. Yes, definitely. Second is credit worthiness. If your credit worthiness is high, you will have more number of avenues or more number of channels of raising funds. If your credit worthiness low, then it becomes very difficult for you. How is credit worthiness identified? In India, credit worthiness are identified through credit ratings by the credit bureaus. Guys, in India, credit worthiness is identified by the credit bureaus. They are given a credit rating. You must have heard A, double B, triple A, or A1, A minus. These all are different types of credit ratings given. Okay. The third is the legal system. Yes, based on the legal system, based on the regulatory framework in which you are working, you can also decide as to what approach of short-term funding you will have. Regulatory concerns, yes, legal system and regulatory concerns go hand in hand. How regulatory concern? See, if you are aware about, I don't know, but banks in India need to maintain a minimum amount of capital. Correct. They have the liquidity norms, SLR, statutory liquidity ratio, CRR, cash reserve ratios, because of which banks and NBFCs need to maintain a certain percentage of their amount as capital, or need to keep certain amount in their liquid assets, designated assets. So that is why regulatory concerns are there. Firms in regulated industries such as banks uh, have restrictions on funding sources as well as amount raised. Correct. And the underlying asset, they serve as a collateral or not. See, different kind of business can have different kind of underlying asset. For example, if you are into infrastructure business, okay, you will have a separate set of assets. If you are in an FMCG business, you will have a separate set of assets. If you are in a e-commerce business, the kind of assets you will have is different. Now, since the amount of assets, the kind of assets you have is different, again the channel through which you can raise will be different. Correct. By giving mortgages, so that will also affect your ability and the decision about your short term fundings. So guys, this was the last topic, and we are through with the chapter. Let us see in synopsis what we have done in the last class. Working capital and liquidity was the chapter's name. Okay guys, working capital and liquidity was the chapter's name. Now it was divided into two parts: working capital and liquidity. This was done in first class. This was done in today's class. In working capital, first we learned about the definition. Okay. Second, we learned about the policy. Third, we learned about the ratios. And fourth, we learned about the cash conversion cycle. And fifth, we learned about the management aspect of cash conversion cycle. Okay. In liquidity, first we learned about the definition. Second, we learned about drag and pull. Third, we learned about ratios. Fourth, we learned about factors affecting policy. Okay. Guys, these were the topics involved in working capital liquidity. In the next class, we will be solving some really good questions on this topic, and we will conclude this topic both from a conceptual standpoint and the numerical and the question standpoint. Thank you, guys, and happy studying.